Hello viewers, welcome to BuzzBite. In this channel, we cover latest and hot topics and trends related to digital assets and how to create values from them or how to benefit from them. This video looks at aftermath of FTX. After the FTX crash, here's what you need to know as an investor. Ordinary buyers should beware. They are being sucked into perilously risky trading that only professionals understand. One can liken the current circumstances in crypto markets to the burst of the dot-com bubble in 2001. The FTX fiasco has continued to topple cryptocurrencies hysterically as investors' sentiment falters. The global crypto market valuation, which was once around $1 trillion a couple of weeks ago, has dropped to below $800 billion, with many cryptocurrencies correcting drastically. Billions of dollars of wealth have been wiped out. Can crypto investors handle more shocks? Bankruptcies seem to have become a trend in the past few months among crypto exchanges as liquidity continues to be one of the major problems among them. And yet it sweeps off investors' trust, leading to a free fall in the market. Looks like the bankruptcy dilemma is not likely to end anytime soon, and there are speculation that crypto brokerage Genesis Trading might be on the queue to get bankrupt. Following the bankruptcy of one of the world's largest cryptocurrency exchanges, FTX, the price of Bitcoin has tumbled again. It is now about $16,500, a far cry from the all-time high of $66,000 just a year ago. Why such a large drop in value? It's because of the combination of exchange like Binance, a stablecoin Tether, and the skilled professional traders running high-frequency algorithms. Unlike stocks, Bitcoin can be traded on many different exchanges, but Binance has more than 50% of the entire crypto market, and as a result it sets the price of Bitcoin and other cryptocurrencies. In order to buy cryptocurrencies, traders must convert fiat money into a stablecoin like Tether. Bitcoin Tether has by far the largest volume of all products on Binance, and because $1 usually equals 1 Tether, trading on Bitcoin Tether sets the dollar price of Bitcoin. But when Bitcoin crashes, so does the entire crypto ecosystem. The issue is that Binance is self-regulated, meaning it is completely unregulated by traditional market regulators such as the Securities Exchange Commission in the US or the Financial Conduct Authority in the UK. This is a great attraction for professional traders because they can deploy high-frequency price manipulation algorithms on Binance, which are against the law in regulated markets. These algorithms can cause rapid price movements up and down, making Bitcoin extremely volatile. Binance does its own clearing and settlements of trades, the same as all other self-regulated crypto exchanges. This means that losing counterparties, those on the other side of profitable trades, often have their positions wiped out automatically without notice. Unlike normal exchanges, self-regulated crypto exchanges aren't required to raise the alarm when a trade has lost so much money that the collateral in the account needs topping up. Instead, traders are solely responsible for funding their accounts by continually monitoring something called the liquidation price. This is done automatically by the algorithms run by professional traders, but it is exhausting for ordinary players like you and me, who need to remain highly vigilant whenever manipulation is being used to create the volatility that professional traders use to increase their profits. When professionals trade against each other, it is called toxic flow, because the chance of profit is more like 50% if their algorithms are equally fast and effective. Professional traders much prefer their counterparty to be an ordinary investor. This is worrying because Binance has been hugely successful at attracting ordinary investors. The fees it earns from this kind of investor have funded its very rapid expansion. It is now branching out with its own stablecoin, blockchain, and NFT marketplace. Binance is consolidating its role as the Amazon of crypto, following a very effective business model. In some ways, one can liken the current circumstances in crypto markets to the burst of the dot-com bubble in 2001 to 2002. The venture capital that had poured into internet startups in 1999 to 2000 suddenly dried up, as many companies went bankrupt. This year, Three Arrows Capital, one of the largest crypto hedge funds, defaulted on its loans, and major crypto lending companies Celsius and Voyager filed for bankruptcy as the price of Bitcoin collapsed, following some unexpected and shocking attacks on a new type of stablecoin called Terra. Following the bankruptcy of FTX, several other exchanges such as Gemini and lending platforms including Genesis are preventing customers from withdrawing their funds. We shall see a lot more of this contagion, precipitating widespread bankruptcies among startups now that venture capital has dried up in the crypto sector. More exchanges and lending platforms, as well as blockchains, NFT marketplaces, data aggregators, and analytics companies, will all bite the dust. A lot of the fears that the collapse of FTX will lead to more destruction in the crypto industry are hitting almost every investor in the United States, from individuals to major Wall Street firms, with many wondering if another cryptocurrency trading platform called Genesis will fall next. At the same time, the collapse of FTX hasn't been limited to companies and investors with direct exposure to the bankrupt business. The spectacular implosion of the exchange, valued earlier this year at more than $30 billion, has stoked volatility in crypto and led the values of cryptocurrencies and Bitcoin, which were already dropping, to fall even more. It's also sparked panic. Investors pulled more than $400 million out of the Gemini exchange, founded by the Winklevoss twins, in a 24-hour period last week, spooked when Gemini briefly suspended its yield-paying program that was backed by Genesis. Other big exchanges such as Binance and Coinbase have seen sizable drawdowns recently as well, according to CoinDesk. Genesis is struggling to raise fresh cash for its lending unit, and it's warning potential investors that it may need to file for bankruptcy if its efforts fail. Genesis has spent the past several days seeking at least $1 billion in fresh capital, which included talks over a potential investment from crypto exchange Binance. The crypto market continues to slide as the FTX situation is still evolving. Bitcoin was sitting on a wafer-thin support. So, what does the future lie for the common investors like you and me? Analysts estimate that the global cryptocurrency market will more than triple by 2030. This all leads to one big trend. Cryptocurrency, once only understood among a relatively fringe community of anti-establishment investors, is now becoming a household name quickly. Analysts estimate that the global cryptocurrency market will more than triple by 2030, hitting a valuation of nearly $5 trillion. Whether they want to buy into it or not, investors, businesses, and brands can't ignore the rising tide of crypto for long. But crypto can't seem to escape paradoxes anywhere. Investors believe in regulation, yet are worried about many of the impacts that regulation will bring about. They're eco-conscious, but crypto has a huge carbon footprint. Digging into these nuances is key to understanding overall consumer sentiment and predicting consumer behavior around a very uncertain future of cryptocurrency. The number of cryptocurrency investors has been steadily increasing around the world for a while, but recent growth has been explosive. What's more, the profile of investors has evolved. In the age of meme stocks and stimulus checks, it's not such a niche hobby anymore. Rather, everyday consumers have seen this new asset class as a way to pad their portfolios with potentially more rewarding, albeit riskier, asset. More recently, the upsides of cryptocurrency have begun to attract institutions and traditional finances rushing to cater to the increased demand, such as U.S. Bank's recent creation of a Bitcoin custody service, which allows hedge funds to take a stake into digital currency. While a larger pool of investment means greater potential for everyday investors, more institutional involvement also threatens digital currency's ability to operate outside of traditional finance. Here begins the paradox. The institutional money that has been pouring into cryptocurrency over the past few years has begun to change the power structure of the market. 13 years ago, cryptocurrency recruited users out of a desire to shake up the exclusive, institutionalized world of finance to create a widely accessible way to move money and pay for goods and services, regardless of individual circumstances. Unlike traditional banks, you didn't even need to have an address to trade in crypto. All you needed was an internet connection. Cryptocurrency, in principle, relies on the collective actions of everyday users to self-regulate. They keep the ledger of transactions, the blockchain, secure and updated, and the process allows anyone with a computer the ability to mine coins. Since the invention of Bitcoin, governments have done relatively little compared to traditional investment categories to regulate or moderate the market. For the most part, cryptocurrency has been allowed to spread around the world as a uniquely decentralized financial asset. Now, the laissez-faire attitude toward decentralized finance is waning. Perhaps surprisingly, investors are actually supportive of new regulations, though they have quite conflicting views about what these policies could mean and who should create them. On the one hand, many investors believe greater regulation could legitimize the fledgling marketplace, enabling more businesses to accept digital currency, increasing their value and security from fraud, all while reducing volatility and criminal activity. On the other hand, many also worry cryptocurrency regulation could effectively limit its peer-to-peer nature, which drew initial investors in. They also see drawbacks to crypto regulation as a potentially larger threat, not just to their wallets, but to the individual freedoms they currently experience in the decentralized and anonymous marketplace. Regulation offers protection and stability, while crypto has thrived from volatility and anonymity. But currencies can't operate without being regulated, especially not to the scale that crypto has reached. Finding a middle ground between regulating a lawless commodity and allowing it to continue to build value will be a challenge for governments, coin exchanges, and investors alike. For this reason, support for regulation is directed not toward governments, but toward payment companies and exchanges themselves. While many consumers are mistrustful of industries that are allowed to self-regulate, in this case they see it as a potential solution to the unique risks of crypto regulation. Either way, it certainly presents opportunities for brands in technology and related fields to become a trusted partner, educator, and safety net, swooping in to fill the gap where governmental trust is lacking. Crypto has always been volatile, both in price and in consumers' perception. Despite the explosion in recent years, what the future of cryptocurrency holds is still unclear. For the average investor, for government regulators, and for those attempting to make crypto greener, this is a time of paradoxes to navigate. If one thing is certain, it's that the market in 5 years' time could be just as unrecognizable to us now as the market was 5 years ago. What the future holds is still unclear. While the future of cryptocurrency will be shaped by regulators, it can also be influenced by brands. Thank you for watching. Hope you liked this video. If you really liked this video and enjoy the content, please click subscribe to get new videos each week and don't forget to hit the bell icon.